So our speaker this evening is Dr. Giuseppe Paleologo. Dr. Paleologo serves as the head of risk at Hudson River Trading. One of his passions is helping portfolio managers get the most out of their investment ideas and their data sets. Over the past 10 years, he has worked in senior roles for hedge funds, such as Citadel, Millennium, and Qontigo. He's the author of the upcoming book, Advanced Portfolio Management, a Quant's Guide for Fundamental Investors. In his prior life, he was a mathematician in the Math Sciences Department of IBM Research. He has a master's in engineering economic systems, statistics and physics, and a PhD in management science and in engineering, mostly from Stanford. This evening, Dr. Paleologo will discuss different types of hedge funds, how hedge funds invest in equities, and how to interpret the data in the 13F filing, depending on the investment strategy of different types of hedge funds. So,
right. Okay.
please go ahead.
Thank you, Elisa, thank you all for having me here. Yes, so the introduction is saying it all pretty much. I would just add I was a colleague of Elisa at IBM Research for about 10 years, and then I got bored of IBM Research, I guess, and I went to work for a quantitative service company, which was Axioma at the time. And then I was recruited by Citadel after a year. And then I've been working with hedge funds or with principal firms since then. So as a background, Elisa was mentioning, I have worked for two large hedge funds. They're called platforms, called Citadel and Millennium. And I have been involved or been very close to a number of other hedge funds that you may have heard of, like Baliasny, where several friends of mine work or are partners or portfolio managers. Holocene, which is the biggest hedge fund launch of 2017. Woodline Partners, which was the largest hedge fund of 2019, and a few others that are smaller or are still incubating. So I have been around at this point. I've been around for 10 years in the hedge fund industry, and currently I'm not working for a hedge fund, I should specify. So I am actually working for what is essentially a high frequency trading firm. So it's a prop trading firm, and I can talk briefly about that as well. Yeah, so that is the way of introduction. So the center of my experience is around hedge funds, but I should maybe mention a little bit how hedge funds situate themselves in the largest universe of investment managers. So in the post-2008 environment, after Chris Dodd, essentially banks were curtailed in their ability to take on speculative risk. Okay, so there were many desks in many banks that were taking a huge amount of risk in mortgages, in equities. They had their own hedge fund owner initiatives, like Global Alpha, for example, for Goldman Sachs, or two hedge funds that famously failed in Bear Stearns in 2008. That is not possible any longer. So in a sense, since 2008, we have seen somewhat a contraction or a consolidation in the world of asset managers. At one extreme, you have institutional asset managers. These are often also a role of custodian, for example, which means that they will keep essentially assets on behalf of third parties. And these are, let's say, the biggest one in the world is, of course, it's BlackRock. I've kind of lost count of how many trillions they manage, but let's say ballpark about 6-7 billion trillions. Then you have State Street. Vanguard is actually the second one. Maybe the third one is State Street. And then let's say Invesco, for example, is a little bit over $1 trillion. So what these firms provide is essentially discretionary asset allocation with various styles, but with a relatively low degree of discretion. So there are heavy requirements, impositions on the way they invest. Some of them, they cannot take short positions. Sometimes these constraints are self-imposed. Sometimes they cannot deviate too much from market returns, for example. Sometimes they're actually just mimicking market returns, like passive investors. Vanguard is almost exclusively a passive fund provider, right? There is a variety of strategies within those asset managers, but they have very stringent disclosure agreements. They have essentially no redemption constraints. So which means that if you want to invest in your 401k in a Fidelity fund, you can do it within 1 day. Your account will be funded. And if you're unhappy, 1 day and your money are returned. Okay. They have to be very liquid and very transparent. They also sometimes have to disclose their positions to investors, at least for some funds. So you're an investor, you have a right to see what's in your portfolio. And so by the nature of their investment, they will not deviate that much from essentially their benchmarks. They will track S&P, MSCI, Russell. That's pretty much the extent of a vast majority of the funds in equities. Some of them will track regional indices like TSX, Nikkei, Stocks 50, Europe, right? TSX is Canada. If you want to make an investment in your 401k for the long run, or if you are a large endowment and you need to have large capacity to invest, you want to invest $100 billion, for example, you have no choice. You have to invest in these kind of vehicles. Either you delegate to a manager, or you are wealthy enough that you are hiring managers like this and they go work for you in Dubai, right? For example. Don't expect huge performance. As a matter of fact, you should expect underperformance from these funds. So my recommendation would be, don't trust them, just invest in passive vehicles. But aside from that, so now the second ladder, the second step in this ladder is hedge funds. So hedge funds essentially started in 1948 by a guy called Winslow, who was a journalist. He had essentially two ideas. The first one was to have long and short positions so that net results would be relatively insulated from market fluctuations. The second idea was to allow to charge a lot, basically, to charge 2% of management fees. So every year they would take 2% of your principal and pocket it, and 20% of the return, active return of their investment. That was great. There was not even a provision for high watermark, which means that if on year one they were making 10%, they would take 20% of that. If on year two they were losing 10%, they would not be paid. And if on year three they would make another 10%, they would be paid another 20%. So this was in the good old days. It's not like that any longer. So the 20%, which is called incentive fee, is only charged on the high water mark of your performance. So in year one, you make 10%, great, you take 20% of that. Year two, you lose 10%, you don't get paid. Year three, you make it back. Actually, you need to make a little bit more than 10% in order to go back to the initial amount of capital. You don't get paid on that because you have not reached the highest point in the capital appreciation curve for your investor. Okay, so management fees have become over time more stringent, more demanding, but the basic idea that Whistler had, which was to charge a ton on active performance, is more or less there. It's still there, as well as the management fees, which are the 2% that you charge every year. This is what hedge funds do. So they are an agent, and there are two types of principals. There is a general partner. Typically, that person is the administrator or the administrators of the fund, and they will receive the management fees. And they typically have more stringent terms on receiving the returns of the fund. So the limited partners don't receive management fees, but they have kind of first rights on the P&L of the firm. So they will get returns first in case something bad happens to the firm. So limited partners are basically silent partners who don't get paid on management, and they are supposed to be sophisticated partners. So you cannot invest in a hedge fund if you don't have, I think, a few $1 million of net worth, of liquid net worth. Hedge funds are regulated by the SEC, the Security Exchange Commission. The new head of the SEC is Gary Gensler, a former partner at Goldman Sachs, who's been a regulator in and out and doing policy for the past 20 years. So these are the hedge funds. They have several disclosure requirements. We can talk about that, but that's pretty much how they work. Sophisticated investors, expensive, and they have more freedom to invest however they see fit. So they can invest long short in equities, they can invest in illiquid securities, they can invest in mortgages, they can carve out a private equity fund within their scope. They can finance reinsurance, which was very fashionable 10 years ago. So they can have a reinsurance arm. Everything is fair game. Some of them, I would say the majority of them, have a couple of funds. So they have a fund based typically in the US, at least for US hedge funds, and another fund that is based in a tax-free haven, like Cayman, for limited partners that qualify. So if you hear of a hedge fund that has a representation in the Cayman Island, it's nothing particularly fishy. It's just because many institutional investors in the world can invest in the Cayman, and they will not pay the same tax rate in their home countries. Okay, so actually that's good for institutional investors, pension funds and the like. So that's hedge funds. And then there is another group of funds that are proprietary trading firms. Okay, so these would be legally, I think, probably Medallion qualifies in Renaissance. There are no external investors, so it's all GP money. Hudson River Trading is another one. Getco is another one. Susquehanna is another one. So there are a few, right? There are not that many. There are many smaller ones, but generally, prop trading firms tend to be technologically savvy because they tend to invest in strategies that require relatively little capital. That's why they don't take external money, and with very high risk-adjusted returns. So the equation is a little bit different. They don't get money from the outside. They tend to be expensive to run because they are heavy on technology, and they tend to be very profitable because the performance of the strategy is high, and if you are invested in these things, you get 100% of the proceeds after paying for the high operating costs. Because they don't take outside money, even from experienced investors, they also have the lightest regulatory regime requirements. So there are some differences. In Europe, regulation is heavier than in the United States, but in general, they are regulated by FINRA, which is a sort of self-regulation. It's not a federal agency. And so they have still various margin requirements and so on, right? So it's not that they can do whatever they want, not at all. And in order to participate in the markets, in any case, they have to comply with a number of requirements as market makers, if they are market makers, or if they are members of a particular exchange with the rules of that exchange. So it's not that they can do whatever they like. That's not the case. But SEC has many more requirements, many more disclosure requirements than FINRA. Okay, so I think this is a decent panorama of asset managers. Now, there are many other people in the world that do some kind of asset management. There are venture capitalists, there are private equity firms and whatnot. In general, it helps knowing what the size of these things are, right? So let's say that approximately there are $100 trillion of equities worldwide to invest in. Okay, so hedge funds have been relatively stable for the past 10 years at about $3 trillion, with slight outflows, slight inflows, but that's pretty much what they are. They're like 3% of the market. Venture capital firms are very, very small. I don't have the exact number, but I think it's definitely less than 10% of hedge funds. So I think that if you sum across all the cohorts, across all venture capital firms, I'd be surprised if they allocate more than $200 billion of capital. And then I think that private equity can be maybe a little bit bigger or on the same order of magnitude of hedge funds. So these are other vehicles. It's not easy to get any allocation or any participation in a private equity firm. So hedge funds are relatively small, 3%, and not all hedge funds invest in equity anyway, right? So there are some hedge funds which will be invested in commodity. So in commodities, they will be essentially so-called CTAs doing some kind of trend following in commodity futures. So that's one style. There will be hedge funds that are specialized in mortgages and credit. Ellington is a big hedge fund based in New York, and they do credit. So not even only equities. Now, within hedge funds, there is a big variety of formats. So the first thing to know is that the 2 and 20 formula doesn't exist any longer. So there are many hedge funds that charge less. They will do 1.5 and 15%, for example. there are some hedge funds that charge a ton more. There is a hedge fund called Element that does systematic macro. They closed to external investors a year or two ago, and they increased their their incentive fee to, I think, 40% or 44%, more than 20% by sure. I don't remember exactly how much, but they're charging a lot. Management fees also vary a ton. So those who can afford it, because are good hedge funds with a very proven stable track record, they will pass through their management fee. What does it mean? It means that you don't pay 2% any longer. You don't even see how much you're paying every year for the joy of paying for the fund costs. You just get a return every month that is net of the operating costs of the fund. So if the fund is paying a portfolio manager within the fund, not a partner of the fund will pay that portfolio manager out of the management fees to the final clients, to the limited partners. You need to have a lot of clout to do this, but there are several hedge funds that can do this. And among them, there is a subclass of hedge funds, not just that do well, but they tend to be very diversified. These are called platforms, and they basically serve as a kind of a hub for portfolio managers. So they will hire portfolio managers. It's an interesting structure because they are agents, right, for the limited partners. The limited partners hire them, and then they hire professionals to invest the money of the limited partners. So it's not the father figure of the GP, general partners, picking stocks any longer. The general partner is a manager of managers. It's a business development person. Is scouting for talent, is giving them money, hoping that they will return this money to investors. And so these platforms are, I think, more or less six or seven. So you have Citadel, Millennium, Baliasny, Point72, Schoenfeld, Exodus Point, and maybe Marshall Wace. Okay, so these are the platforms pretty much. They have a asset under management, or AUM, that varies between $52 billion, that's Millennium, all the way down to I think $8 billion for Schoenfeld / Baliasny, but let's say 10. So 10 to 50, that's the size. It's a pretty big size for a hedge fund. So all of these funds pass through their fees, which means that if you are a portfolio manager in these funds, you get paid based on the fees that are passed through to the limited investors. And typically you are paid a structure that is very similar to the original structure of 2020, but you get paid only the performance, not the management. So if you make money on a given year, you will basically get a percentage of your generated P&L. Let's say anywhere between 10 and 20%, or sometimes even more. There is an additional wrinkle, which is that they are first going to pay to the platform their costs, their operating costs, and then they get paid a slope is a percentage of what they earn. If they're losing money, they have sometimes to return what they earned in the previous years. So these are called clawbacks, and they serve a function of moderating the risk appetite of the portfolio manager. So if a portfolio manager didn't have any clawback, they would take infinite risk, hoping to hit it big, and then they would run away with the money. That's not the way it works. So if you lose money, you basically return part of it or all of it to the platform until you make it back. Okay, so it's an important aspect in case you want to become portfolio managers. Now, what else? What do these people do? I mean, that's a big question, right? Why do they get paid more? So once in a while, actually not once in a while, it's almost regular. Every year, there is some, I would say, uninformed journalist who will say, oh, hedge funds are underperforming this year too. Okay, so I remember an article by Ezra Klein on the Washington Post, but there are so many others. It's almost a refrain, it's cut and paste. So why would anybody pay hedge funds for underperforming, right? The reason is that hedge funds have to produce returns that are superior in quality to institutional managers. How do they do it? By providing returns that are uncorrelated to the market and therefore also uncorrelated to those of the institutional asset managers. If you are able to make money when the market loses 40%, like in 2020 or in 2008, that additional dollar that you are providing to investors is extremely precious, because that is when they need to consume. Basically, they have a high marginal utility for consumption. And if everybody else is losing money, that dollar that you're making allows them to consume and to receive more utility out of that. So that's a very important value proposition for a hedge fund. And it checks out that hedge funds are just 3% of the AUM, because in practice, a good hedge fund won't make 20% a year. Actually, there are some that do, but let's asterisk them for the future discussion. Typically, a hedge fund will make close to market returns, not outrageous performance like a prop trading firm. But these returns tend to be uncorrelated from the market, and they tend to be low volatility. So your Sharpe ratio, if you know what a Sharpe ratio is, if you don't, basically a Sharpe ratio is equal to the expected return of a fund divided by the volatility or standard deviation of these returns over the course of a year, right? So the Sharpe ratio for a passive investor is typically 0.4 or 0.5, right? So the market makes, let's say, 8% and has a volatility of 16 to 20%. A hedge fund may have a return of 8% and a volatility of 8% or even less, if it's a good hedge fund. If it's a very good hedge fund, it will have a return of 16% with a volatility of 8%. So Citadel has annualized return of about 16%. Millennium a little bit lower, but also lower volatility. All right, so that's very beneficial to pension funds or sovereign funds and similar large investors. They want to allocate a little bit of money to hedge funds to give them a little bit of stability to counter the wild ride of the markets. So that is why hedge funds are still in business. And that is why it doesn't make much sense to say, oh, hedge funds underperform the market. That's not their role. They don't need to underperform the market to be very profitable. Now, having said that, there are some hedge funds that outperform the market, at least seemingly so. Among them, the so-called tiger cubs play a special role. I don't know if you ever heard about Tiger Cubs. No? Okay, so there was once upon a time an investor called Julian Robertson who started in like 1980, let's say, in the early 80s. No, mid 80s. And embarrassing, I don't remember, but let's say mid 80s, okay? And he had an amazing streak. He started with millions, and by 99, he was managing more than $20 billion. This guy had a very specific style of investing, very concentrated in a few stocks with a very high hit rate. So essentially aiming for huge gains and high risk tolerance. And in general, also value oriented. So he was looking for companies that he thought were mispriced based on fundamental properties. So this was a fantastic run. In 1999, at the height of the dot-com boom, all these positions were losing money because these positions were not based on fundamentals. He had 2 years of severe underperformance, and he shut down his fund. And sure enough, in March of year 2000, all these companies went bust, and he would have made a fortune. Okay, so Buffett stayed in the business. He called himself stupid in some of his investor letters, and then, sure enough, a year later, he was vindicated. Robertson didn't have the patience and shut down his fund for good. However, in the course of the previous 10 years, he had mentored an amazing group of portfolio managers and investors. And these people went to create a number of hedge funds. Lone Pine is the biggest and most successful, but then also Viking, Tiger Asia, Tiger Management, Qontigo, and many others that I don't even remember. Okay, but these funds, many of the most successful funds, have a compound return, an annualized return of 17, 18%. So he has been a fantastic mentor, and he has created a sort of, oh, by the way, also Archegos. You know, Bill Wang was a portfolio manager for 4 years in Tiger Global in the tail end of the 90s. And he was seeded by Robertson. Seeded means that Robertson took a general partner position in Archegos, which is a very attractive thing to do if because you get management fees, you get the whole economics. And Bill Wang, who was maybe a little bit fishy because he got banned for some wire fraud. Wire fraud basically is a kind of infraction where they ban you from the security industry for doing, you probably did something very bad, but they cannot they cannot prove it, so they will charge you with wire fraud, which is a lesser charge. So it might have been effectively an insider trader. We don't know. The fact is that he had a very, very good 10-year more than 10-year performance track record until he crashed. So Bill Wang is another Tiger Cub. He was considered a legend until he wasn't. So yeah, so this is kind of an outlier though. If you look at many hedge funds, they really survive with lower returns than 18% annualized. Citadel has, I think, 17, or last year had a 24%. So Citadel probably did better than most. And I think it's at 17. Bridgewater is much lower. Many other funds that you may have heard of, like Capital Fund Management or Millennium, they don't get to these levels. They are, I think, below 15%. Okay, so, everybody will quote you, oh, we did fantastically well between, May 2005 and April of 2011. But this is complete bullshit. I mean, you have to look at their performance pretty much. Oh, by the way, another thing that they will tell you is, oh, but we did great inception to date. That is also bullshit, because when you are below $1 billion of AUM, you are expected to have very good performance. You are expected to have very high returns. You're very nimble, and it's early in the history of hedge funds, so it doesn't really matter. The performance is what you did at scale over $1 billion until the present. Another measure of hedge fund success is how much money they actually return to investors, like the sheer number of dollars. And in this metric, the most successful hedge fund I still think is Rentec. Second is Soros. Soros was second for a long time. Bridgewater, by virtue of its sheer size. Bridgewater is a huge hedge fund. Citadel is fourth, and then there are a few. Millennium is fifth or sixth. So this is more or less the ranking. Okay, so so performance has to be good on a risk-adjusted basis and adjusted for correlation to the market. How do hedge funds do this? Okay, so that's the next question. How do they provide these high quality returns? So they do it in a variety of ways. Number one, since the vast majority of hedge funds invest in equities, they will typically have a quantitative model that identifies in their portfolio what are the systematic sources of risk. So this is what having beta exposure means. They will see how much of your portfolio is correlated to the market, and then make sure that it's not correlated to the market anymore. How do they do it? Well, if you're long some stocks and short other stocks, if you are more long than short, so you're net long, you tend to be correlated to the market, because you have, let's say, $2 of Apple for every dollar of IBM. So your stock behaves more like a net long stock, and it's basically inheriting some features of the market. That is a very simple thing to do, right? To run a portfolio that is not only dollar neutral, so that it has the same amount of dollars invested long and short, but also that is beta neutral, which means that the sensitivity to the market for every single stock, when you sum it across stocks, it tends to zero out. Then there are many other factors that matter. So the most famous factor maybe that you've heard of is momentum, right? Momentum is that phenomenon by which, if you are investing in stocks that have been winners over the past 12 months, and your short stocks that have been losers in the past 12 months, you have a portfolio that has zero beta, more or less, but that is outperforming. So it has positive returns, because winners tend to be winners and losers tend to be losers, at least over the time scale of a year. This seems great. And there are some asset managers that do exactly this. They will just be long momentum. They're investing in the winners and shorting the losers, or they are going to be long the value stocks and short the growth stocks. That's another investment style. And they will superimpose many of these styles together, hoping to compound them, to smooth the returns of these individual styles into something that on average makes money year in and year out. Now, this seems great, but this is not what hedge funds should be doing. Hedge funds should be running neutral, not only the market, but also all these styles of investing. Why? Because if you are just making money by investing in these kind of styles, you don't deserve to get 2 and 20. Okay, you need to do something more than this. there are still hedge funds that will do this. I don't think for the long run. You need to do something better. Associated to this, and maybe this is a good point to segue into the 13F discussion, right? Another investment style is to scour for positions or for ideas in public documents. And 13F, which takes its name from an SEC regulation that was created in 1934 and many, many times amended. 13F is a form that hedge funds are required to submit to the SEC, I think, every quarter, okay, up to 45 days after the end of the quarter, and reporting all their positions, long positions, at the end of the quarter. You probably are familiar with this. I don't know, do you know 13Fs? Have you seen 13Fs? You have, okay. 13Fs are public documents. Now, the fact that they're public documents doesn't mean that they're easy to obtain historically. So there used to be an independent company called Lion Shares. It was purchased by FactSet. So FactSet has this curated database of historical 13Fs. There are also new entrants in this market. We buy from a different vendor, for example. If the data are good enough, they should all be the same, but you will be surprised if you buy from different vendors, how big the differences can be. Now, 13Fs contain the long leg of equity portfolios. And the idea is simple. If I get enough of those and I know which are the good hedge funds and which one are the bad hedge funds, I can create a portfolio. I can use these as idea generators, and I can create a portfolio that is well constructed. It does not have all these style factor exposures I don't want. And because it's inheriting these great ideas, will outperform. Now, what's the problem with this? So there are several. The first one, it's very easy. It's that these data are stale. Okay. Best case, they are 45-day old because nobody submits on the first day. Worst case, they're 135-day old. And for many hedge funds, the returns of putting in your portfolio a new idea, the returns are realized early in the life of the trade. So I put an idea on, I am going to make money in the first 5 days after I put this idea in my portfolio. The second 2 weeks after this first week of trading is much, much weaker. After that, maybe there is absolutely nothing. There is no return. Okay, so 13Fs start with a delay that is greater than 3 weeks. You know, they start really with a delay that is 6 weeks. So staleness is a big deal. The second problem is to identify the winners from the losers. So, okay, now you don't have a stock selection process. You don't have to find out which are the big stocks and which are the bad stocks, but still you have the problem of finding out which are the good portfolio managers, the good firms, and which aren't. And it seems easy, but it's not easy. Like if you look at Citadel, just to quote my favorite example, because I worked there almost 5 years, you know, Citadel seemed it could do no wrong until September of 2008. They had $23 billion in AUM. And then they had 3 months of minus 20% returns. So they lost in 3 months more than 60%. They returned on that year minus 54.6%, but that is a little bit too optimistic. Citadel lost more than 60% and waived the management fees to their clients. So these management fees were passed through and they were much bigger than 2%. So probably Citadel would have lost 6%. What does it mean? That if you look at the 30F of Citadel, until mid-2008, you would be overweight Citadel ideas a lot, right? Because this was one of the best performing funds. And then you would have lost lots of money. Now, actually, that's not entirely true. Why? Because even though Citadel underperformed heavily as a fund, it actually outperformed in equities. So the 13Fs probably would have been a good idea to invest in still. You would have been in luck, specifically for Citadel 13Fs. You should, if you have 13F data, you should actually backtest the performance of 13Fs of Citadel in 2008 and see how they worked. Now, another problem is with 13Fs, another challenge is that 13Fs are only showing you the long side of the portfolio, but not the short side. Many of these positions don't exist in isolation. They exist as part of a pair or as part of a group. So this means that if you see a position that is a long JP Morgan Chase, for example, it is possible, but not guaranteed, that the same portfolio manager might have been short Citibank. That's a typical trading pair, because portfolio managers will look at the relative value of comparables, of comp stocks. All right? So you don't see the short side of the portfolio manager's positions. Now, what you can do is to take an agnostic view and say, I am going to create a portfolio that is long JP Morgan Chase and is short a basket of banking stocks, right? So that on average, my position has the same amount of long and short in banking. And for example, it's net the market, it's net the momentum factor that I mentioned before, and so on. And that's fine. Your portfolio will be factor neutral, will not have all these systematic exposures, but will not necessarily have the alpha that the portfolio manager had in mind to start with. So that's another challenge with 13F. Okay, so you have a selection problem, you have a tardiness problem, you have basically a staleness of the data problem, and then you have a portfolio construction problem. There is a book that you can find online if you look hard enough by Meb Faber. Okay, do you know this book? Have you heard about this book about 13F analysis of hedge funds? So bear with me. Actually, I'm going to find it. So Meb Faber is a podcast host, and okay, now I don't find it. I should have done my homework before. Okay, but Meb Faber is primarily a kind of a minor celebrity. He has a podcast, he has a blog, he wrote simple papers, so it's kind of known. He also is a surfer. He likes surfing, probably is better at surfing probably than he is at investing, but whatever. He has written many books. So this book that is written, you have to find, is a book in which it takes individual hedge fund managers, look at the 13F, and you see Meb. I'll follow up, by the way. I'm going to find this and I'm going to send it to Alisa. So if you're curious, I'll get you the EPUB even. But in short, the exercise that this guy did was taking the 13F of a bunch of famous hedge funds and back tested, right? So take a subset of the positions, only the high conviction positions delay by a couple of days, which is the right thing to do. So it was not done very badly, right? It was done with some criterion. And then look how this thing performed. And according to this simple tests, there was a lot of value in the 13Fs. So I think that's a little bit optimistic. There is a lot of hindsight bias. There is survivorship bias to start with. Some hedge funds didn't survive, and so he's doing the thing after the fact. I would definitely take this with a grain of salt. But I wanted to mention it because it's one case where 13Fs have been used. Another case is a paper by Qontigo and the best idea paper. Have you heard about the best ideas paper? It's on SSRN and called, I think, Best Ideas. Also looks at the 13Fs. And there is a third paper that I know of, which is published by Barclays. So I don't have access to it anymore, but maybe at Yeshiva you can get it, or you can ask Barclays, and maybe they can take a liking to you because you're students. So there is also that paper that analyzed the effectiveness of using 13Fs. So the conclusion is, I think that there is some. It's definitely useful to look at 13Fs. It's useful to see 13Fs to get a sense of the consensus of positions and of hedge fund managers. It's not going to be a super high sharp strategy in itself, but it does contain some information. And again, there are limits to the data. For a short period of time, it seemed that 13Fs would not be even a viable source of data any longer, because only asset managers with not asset under management, but with assets invested greater than $100 million are required to submit 13Fs every quarter. And for a short period, last year, the SEC proposed an amendment to this rule so that only firms with more than $3.5 billion invested in the markets would have to disclose their holdings. That was a proposal. There were requests for comments, and the comments were almost uniformly negative. Trump lost the elections, and that proposal was shelved. And so, as a matter of fact, it is possible that the rule will become more expansive in the future, by which I mean that most likely not only equities will need to be declared, but also some derivative products. Why? Because firms like Archegos, for example, or Archegos, were not holding equities outright, but they were holding total return swaps on equities. So this is a derivative contract that doesn't entitle you to own an equity position, a stock. A counterparty buys the stock, and you have an agreement with that counterparty to receive the returns of the stock, okay, in exchange for payment. So in terms of cash flows, it's identical to a stock, but you don't own the stock. And Medallion in Rentec used total return swaps in order to pay less taxes as well. And so that case has been ongoing for years, because the taxes that had been avoided are in the range of $10 billion. And so eventually they will come to an agreement to pay some of it, right? So I think regulation will be a little bit more stringent, and maybe you will get a little bit more of this out of the 13Fs going forward. But the history is what it is, and it's suffering from all these problems.
Thank you very much, Cappy. This was extremely informative and very, very clear. So I really thank you.
My pleasure. Good luck with your projects.